Canada just added 75,000 jobs in a single month. That is a 0.4% jump in total employment, and the unemployment rate dropped to 6.4%, the lowest it has been in 2 full years. To put that in perspective, economists generally consider a monthly gain above 20,000 to be a strong report in Canada. This is not a strong report. It is an exceptional one. Before you celebrate or panic, you need to understand exactly what this number does and does not tell you, because the implications run straight into your mortgage, your rent, and your next paycheck. The Bank of Canada is currently sitting at a policy rate of 2.25%, and every major jobs report directly influences whether they cut, hold, or raise at the next decision. The BOC has 2 mandates: control inflation and maintain a stable, full employment economy. When 75,000 jobs appear in 1 month and unemployment falls to 6.4%, that tells the bank the labor market is running hotter than expected, which typically reduces the urgency to cut rates further. The 2-year Government of Canada bond yield is already at 2.82%, and the 10-year is at 3.55%, meaning bond markets are pricing in an economy that is not desperate for stimulus. Your action here is simple. Do not assume rate cuts are coming automatically. Treat the current rate environment as the baseline when you run your housing or renewal numbers. A tighter labor market with low unemployment historically puts upward pressure on wages, and rising wages can keep inflation elevated longer than expected. If inflation stays sticky, the Bank of Canada has less room to cut the policy rate. Fixed mortgage rates in Canada are priced off bond yields, not the BOC policy rate directly. And with the 10-year yield sitting at 3.55% right now, fixed rates are not about to fall off a cliff regardless of what the BOC does next. If you have a renewal coming in the next 6 to 12 months, the concrete move is this. Lock in a rate hold with your lender or a mortgage broker today, up to 120 days before your maturity date. You get the current rate guaranteed, and if rates drop, you can renegotiate. Do not wait and assume cuts will come save you. More jobs and lower unemployment sounds like good news for workers, and in one important way it is. A tighter labor market gives employees more bargaining power for higher wages. Historically, unemployment near or below 6.5% in Canada has been associated with real wage gains, meaning pay increases that outpace inflation. But here is the tension. If wage growth accelerates significantly, businesses pass those costs on to consumers, which can reignite the very inflation the Bank of Canada has been fighting. Your cost of groceries, rent, and services does not automatically fall because more people have jobs. The practical takeaway is to use this moment of stronger labor market leverage to negotiate your own compensation. If you have not had a meaningful raise in the last 12 months, this data gives you a concrete, factual argument to bring to that conversation. The Canadian dollar is trading at 1.4026 US dollars per Canadian dollar as of August 5, 2026, meaning it takes roughly 1.40 Canadian dollars to buy 1 American dollar. A strong jobs report like this one tends to strengthen a currency because it signals economic health and reduces expectations of rate cuts, both of which attract capital. If the loonie strengthens even modestly from here, that has real effects. Imports become slightly cheaper, which can ease some inflation on goods, but Canadian exports become more expensive for foreign buyers. For the average Canadian, a stronger loonie slightly reduces the cost of anything priced in US dollars, including many online purchases and travel to the United States. If you have been holding off on a US dollar purchase, a jobs-driven loonie rally is a reasonable window to act. A headline number of 75,000 jobs is only as meaningful as the quality of those jobs. The data confirms this was a broad-based gain reflected in a national unemployment rate of 6.4%, but the composition matters enormously. Full-time permanent positions build consumer confidence and drive major financial decisions like buying a home. Part-time or contract positions are much weaker signals of economic momentum. Until a detailed breakdown by sector and employment type is fully analyzed, treat this headline with calibrated optimism rather than full confidence. The action for you personally is to look at your own employment situation honestly. If your income is contract-based or part-time, do not use this headline as justification for a major financial commitment. Base your decisions on the stability of your specific income, not the national average. The Bank of Canada's next scheduled rate decision follows this data, and this jobs report materially changes the calculus. Before this number, the expectation in markets was tilting toward another potential cut. A 75,000 job gain and a 2-year low unemployment rate gives the BOC strong reason to hold at 2.25%, while they wait for more data to confirm whether this is a trend or a single-month spike. Bond markets are already signaling this through yields, with the 2-year at 2.82% remaining notably above the current policy rate. The forward-looking move is to stress-test your financial position at the current rate of 2.25% and at a slightly higher rate, not because a hike is certain, but because a strong economy removes the floor under further cuts. Run that math now, not after the decision. Here is the single most important thing to take from today. 75,000 jobs and a 6.4% unemployment rate is genuinely good economic news for Canada, and it directly affects interest rate expectations, your mortgage costs, your wage negotiating power, and the value of the Canadian dollar all at once. Good macro data does not automatically mean your personal finances improve. It means the environment has shifted, and the people who benefit are the ones who understand the shift and act on it. Lock your renewal rate early, negotiate your wages while the labor market is tight, stress test your budget at current rates, and do not assume cuts are coming to rescue a stretched financial position. This is exactly the kind of data the Loonie report breaks down every time it drops, grounded in real numbers, no fluff. If that is useful to you, subscribe, because the next rate decision and the next jobs report are coming, and you want to understand them before they affect your wallet.